Well, it's been a quiet start to Friday trading, but it's been a big year for stocks. All-time highs. We've seen them on both sides of the border this week, and now investors are starting to get ready for interest rate talk as we move into next week. Jimmy Lee is CEO of Wealth Consulting Group, one of our regulars here on BNN Bloomberg. Jimmy, it's nice to have you back on the program. Let's just start with where we are, where your head is at after this big run-up for stocks.
Great to be with you. I think that investors have been waiting anxiously for the Fed to start cutting. And, it's a certainty that the Fed will cut this month. So I think that's starting to settle in, and that's obviously helping stocks go higher. One of the things we think may happen is that we could get a little bit of volatility now, but going into the year end, we think the stock market could go much higher, actually, even approaching 7,000 on the S&P 500, which is, it'd be a fantastic move up from here. And companies in the United States have done an amazing job of protecting their margins. And so we're expecting that earnings will continue to be solid and going into year end. So we like the cyclical sectors. We do not believe that we'll go into a recession. Definitely slowing down a bit in terms of consumer spending at the lower end of the consumer, but we're bullish on the market.
It's interesting. I was talking to a guest earlier in the hour who went beyond just whether the Fed will cut rates next week and whether there's more cuts in the cards for 2025, which could be sort of additive to that corporate profit story that you've talked about. He more specifically described the Fed put, the idea that investors right now, to a certain extent, maybe they just feel like they've got some protection to take risk out there. Now, I know that sometimes gets a bit cloudy because there's been so much coverage and conversation around tensions between the White House and the central bank. But what do you think of that idea?
Well, I think that's a good sentiment. I think that absolutely, lower interest rates absolutely will help out consumer confidence. I think that once the real estate market, especially residential, starts to move more next year with lower rates, I think that's going to really change the psychology of a lot of investors that have missed this market. And there's a lot of dry powder out there also, so it's still sitting in cash. Even institutional investors that were just not invested. This is one of the most hated bull markets that we've had in a long time. We're coming up on a 3-year anniversary now, almost, with this bull market, and a lot of people just missed it. And so we also think that we're going to get a broadening as rates go down of different types of participants in this rally. So we're expecting smaller cap type companies doing better as rates go down, and we think that we'll also get follow through on overseas markets.
And in terms of individual sectors, like I'm just looking, obviously the tech stocks have had a great year. Most sectors of the S&P 500 are higher. I would say financial stocks are a little higher than middle of the pack. Like they've done well, but I do wonder what you think about the outlook for a group like that in this environment.
We like cyclicals. We've been overweight cyclicals all year long. So we like industrials. We do like financials. We think that, again, business activity will pick up with lower rates. We also think that the effects of deregulation will also help a lot of businesses make decisions on spending more money. And, we think that the new tax bill here in the U.S. will also ramp up some CapEx. So there's a lot of, momentum, I think, behind the market right now, and it could be set up for a nice rally up. One of the things that we're worried about is a melt up, which then could cause a little bit a bigger correction next year. But I think investors will buy the dip, and so I think this bull market has legs. I also like bonds. I mean, like right now there's a lot of assets that are potentially going to do well with lower interest rates.
Okay, I guess if we're trying to watch for any wild cards, Jimmy, what would be sort of the other considerations you're watching along the way here?
Well, geopolitical has been on the top of my list in terms of what could cause market volatility. I think there's also optimism about the war ending in Ukraine and Russia, and if that doesn't happen, who knows? Also, we want things to settle out in the Middle East, and so I think geopolitical risk is still up there. I think that we could get a little bit of too much optimism also that could cause the market to be more volatile. Like I said, a melt up. A lot of people would not have guessed that we could approach the highs where we're at today, during April this year. And so it's a lesson learned for a lot of investors that are trying to day trade and time the market, and even professionals when it comes to that.
All right, Jimmy, thanks very much. Helpful context. Jimmy Lee, CEO of Wealth Consulting Group, joining us with his perspectives on the market.